Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Mark Marex, Senior Specialist with Index Research and Development with Nasdaq Investment Intelligence, to discuss Nasdaq-100 performance in the context of the big U.S. banks, interest rates, and bond market returns. And Mark, it's interesting, when you think of the Nasdaq-100, the banks typically don't come to mind. So what are you looking at specifically here?
Yeah, sure, Jill. I thought it would be interesting to look at what's happening in this sector that I think gets a lot of play in the financial media these days as being something that should be outperforming in a period of rising rates. Financials, along with other kind of rate sensitive sectors, cyclicals like energy, materials, industrials, traditionally, empirically have been shown to outperform when rates go up. But, there's a lot of buts to that. Caveats range from anything from where rates are starting. If they're starting from a very lower bound like we have recently, the behavior, the reaction function is different from if you're starting from a higher point. The pace of rate increases impacts how stocks react, and also the pace and nature of inflation impacts how stocks react. And so what you're seeing in this first slide is the NDX there in the dark blue. You can kind of see it going negative at the very beginning of this year. In January, it was underperforming all these banks. What I'm showing here is sort of the six big corporate and retail banks in the US: Citi, JP Morgan, B of A, Wells Fargo, Morgan Stanley, and Goldman Sachs. The latter two, of course, being more of the investment bank variety than the retail bank. But still, by market cap, by total assets, these are pretty much the big six. And you saw that divergence in performance in January. But look what started to happen kind of in mid-February, with the exception of Wells Fargo, which is year to date more or less unchanged in the light blue. A lot of these banks have converged down to the level of the Nasdaq-100, which as of yesterday's close was a little over 15% negative year to date, having another tough day today. But the pain today is pretty well spread out across the market, and you can see that there's not that big of a difference between high growth, supposed to be very sensitive to rising rates on the downside, Nasdaq-100, and these banks which are supposedly supposed to outperform.
And Mark, going back to your point before on inflation, if we take a look at your next chart here, we can certainly see how the big banks are predisposed to wage inflation as they're looking to compete with talent that many industries are competing with.
Yeah, exactly. And this is the point I try to drive home in putting into context performance of the Nasdaq-100 versus other parts of the equity market this year and going forward, is don't just assume that if we have the highest inflation today that we've had in 40 years, that it's going to be the same as it was 40 years ago. Don't assume that tech as a sector is the same. Don't assume that financials as a sector are the same. Last year, kind of around mid-year is when these headlines started popping up, of every bank basically going in a circle and chasing each other in terms of matching salary raises for their more junior staff, their biggest pool of labor, at least on the investment banking side. That has since spread, and that's part of the reason you've seen bank stocks take a beating after the earnings reports got going in mid to late January, is because Goldman had a 33% jump in pay expenses. Guess what? That's not Goldman paying bank tellers. That's Goldman paying everyone from their junior analysts all the way to their biggest, money makers at the MD and at the partner level. So banks are feeling this wage inflation, actually, very interestingly, from both the bottom end in terms of, if you are a retail bank and you have a lot of lower end workers on the retail side, there's wage inflation there, and there's also wage inflation on the top. It's not something you're seeing necessarily as much in the tech world, outside of maybe Amazon, which has a lot of, has a big employee base, has a lot of those lower wage workers. Apple, Google, Microsoft, they just don't have that same type of exposure. And I would argue that they are much less susceptible to wage inflation taking a hit on their profits, taking a hit on their valuations going forward.
Mark, that's a great point that you make, because we get this comparison of perhaps stagflation or the inflationary environment that we had 40 years ago. But to your point, it was an energy economy back then. We're a tech economy now, and you know better than anyone when it comes to index weighting, how the energy weighting has really shrunk in a lot of these major indices. So it does make sense, to your point, how it might just be impacting financials a little bit more than it might be impacting the broader economy. Let's take a look at your last chart here and compare fixed income products to what rates are actually doing.
Yeah, so I mean, the last point about the banks is that, even though they're hedged in terms of a lot of the holdings that they have in terms of making markets and things like fixed income, they've still got big books of fixed income assets that they have to reinvest their excess reserves in. When you look at what's happened in fixed income, you get a lot of headlines around, oh, inflation's the worst we've seen in 40 years. We've actually, in some ways, never had a worse start to the year in fixed income. And it's across not just the kind of lower quality fixed income assets in leveraged loans and high yield bonds. High yield bonds I'm showing here on the yellow, down 7% year to date, but actually investment grade is taking a huge beating too, down over 9%. That's that gray line, the Bloomberg Barclays Ag for the US, over 9% year to date through yesterday. And all the rest of the lines on this chart, those are showing you the 2, the 5, the 10, and the 30-year rates on the US government bond complex. We started out, all of those were under 2%, some around 1% at the beginning of the year. Now they're all getting very close to 3% and even breaching above that. So another thing, again, to keep in mind, you hear the headlines about, well, rates are rising, financials should outperform growth, should outperform tech. Take a step back and think about, again, the starting point here with rates as low as they were, 100 or 2 basis point move off of a very low starting rate is much different than moving off of a 5 or 10% starting rate on a government bond. That has very different impact on prices, and banks with their large portfolios of fixed income are not going to be immune, and that's certainly part of the reason they're under pressure too, not just from the wage inflation side.
All right, Ben, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.